Thanks so much for tuning into Talking Point. I'm your host, Neeraj Shah. The Talking Point today are the views of Mr. Shishir Joshipura of Praj Industries. They came out with the Q4 numbers on day before yesterday, and the revenues at about 386 crores. Well, compared to estimates, did very well compared to Q4, and it might be a wrong thing to say, as I said in the trade setup yesterday as well. It's not right to compare it seasonally, but compared to Q4, the numbers came in a bit lower. But you have to admit that in a seasonally weak quarter, the execution seemed to be higher than what was believed otherwise. The problem area, if you will, could be the margins, and that's something that I'm going to speak to Mr. Joshipura about. Mr. Joshipura, great having you. Thanks so much for joining in. I hope all is safe.
Yes, all is safe. Thank you very much, Neeraj. I hope everything's safe at your end as well.
Yeah, touch wood, all okay. Can we start off with how you thought the quarter was? Because when I looked at some of the numbers, better than execution, better than expected execution in Q4 in PHS was witnessed. And how did that shape up in this quarter? How was Q1 for high purity, as well as about the bioenergy performance as well, of course?
Well, I think the way I looked at the quarter, of course, it was full of its own challenges, but we'll talk about them separately. But first, what was very significant for us is that we have created the momentum on the order book, and that has been maintained. We are able to build on the opening order book. We have invoiced what we invoiced, but we have had a closing order book which was higher than the opening order book, and we are expecting, looking at the way things are, that is something that we should be able to maintain over the coming quarters during the year as well, that we'll be able to build on the order book. So I think that augurs well for a long, sustainable kind of a growth visibility for the company. So that I think was a very big positive. We have also seen, we've talked about this whole ethanol story in India unfolding, and that is now here playing out because we are able to see an order book, and I'll just give some numbers. So in the whole of last financial year, which of course was a very unusual year of 2 halves, but having said that, we have the country contracted for creation of capacity equal to 145 crore liters of ethanol. In the last quarter alone, we did 133 crores. So that is the shift. So it's 90% of the yearly capacity. Of course, very, very unusual. And I think that is why some of us are struggling, because strictly speaking, there is no comparison to last year, right? But first quarter for us traditionally is very low. It is the lowest of all the 4 quarters, the way our business structure. So that has not changed fundamentally. It is still in the same boat. That this is our lowest quarter to start with because of the seasonality impact and the fact that the 4th quarter was an accumulated impact of the last year and so on. So that's where we are, and I think overall very happy. Some of us, and most important for me was understanding the strategies that we have deployed. Are they playing out or not in our other businesses as well? And I think whether it is about what I would call as whether it is about our PHS business that you mentioned, the high purity business, whether it is CPS business, I think what we have set out to do is what we see coming back to us. So that's the important part. And more satisfying for us. Yes, the quarter is full of its own challenges, and we can talk about that as we move along. But yes, I'm very happy with what we've been able to put together.
Okay, well, those numbers are astounding when one looks at the order book differentiation for FY21 versus Q1 FY22. Albeit FY21 was challenging. And I thought, since you invoked the order book, I was going to come to that a bit later on. Let me come to that straight away first, then we'll move on to the other pieces. So if Q4 was the highest ever order intake for you, this one beat Q4 marginally, so you must be happy with that. Can you tell us whether the segmental breakup of the order inflows or order intake was in line with what you had anticipated and in line with history, or did some segment order inflows did better than the other? And how do you expect it to shape up as well? Do you expect this run rate to continue?
Yes. So Neeraj, I mean, I just put 2 contrasting numbers so that, we knew that brewery business is not going to do well at all because there is no brewery traction right now in the business. Beer consumption is at an all-time low and so on. So we were not expecting any business to flow into brewery other than some small orders for modification, etc. And that's where it was. On the other hand, we knew that domestic ethanol is a story that is unfolding, and we should see a very healthy order book on domestic ethanol, and that's what we saw in the quarter as well. So entire bioenergy booking that we are showing for the quarter at around 500 odd crores is from the first generation ethanol business for ours. So that's very clearly playing out in the game. Most of our businesses are projects businesses in nature. So, for example, in the quarter that ended in December last year, we had this huge contract coming in from IOCL for our ZLD system solution line. The fourth quarter saw a mixed bag of everything. There was part from CPG, there was part from 1G ethanol, there was part from CPS, all the businesses, PHS, all of them were sort of coming in together. Some businesses in this quarter as well, PHS, very, very positive development for us in this quarter. This is their best quarter ever that they have launched on the order book side. So of course that will start to play out on the sales side dimensions as well. So very, very constructive development of order book. It's not coming from quarters we did not think that it will come from, or where strategically our intent was not. I think it's very much in line with what we expected it to be.
Okay. I believe you said it in our interaction the last quarter or one of the others, but I just wanted an update here. You had mentioned that you had witnessed traction for pharma grade alcohol due to the increase in the need for different types of sanitation. You received a contract for the single largest pharma grade alcohol facility for a customer in the US as well. I believe it's a recent development. Can you talk a bit about that? Because you're also expecting building up further after this initial success, and you had bagged maybe 3 or 4 more orders too.
Correct. So, pharma grade alcohol actually puts it a little different because you're talking of very high purity levels of the end product. So that is one. And second is, of course, the potable alcohol. So these two are the categories where your process prowess is sort of proven on the ground with the customer, because the level of purity that is required is very different in nature compared to, say, ethanol. Now, the mention that you make about is the United States. That is the project that we are now constructing for some reasons of their own. The customer, after we shipped the plant and it was on mid-sea, the customer decided to change the project site in the United States. But that was okay with us. So, and then that led to some other issues to be addressed, which we have now. Therefore, and they had their own reasons to do so. I mean, not that they were wrong. So those 2 critical plants that we supplied, one in United States and one in Canada, are right now under construction phase. So once they are commissioned and on the ground, we'll be able to walk and showcase to our customers saying, look, this is what we've done. And this is what our quality, we are able to produce this as a quality. So I'm sure that will lead us to further inroads into those markets for us.
Okay. Now, a word on the obvious, which is ethanol. You would have been asked about it a gazillion times already. But I was wanting to ask you, did you see anything different in the ethanol ordering this time around, aside of course, the quantum of orders that might have come your way? And a follow-up to that is, last quarter, I remember you told me that you are 2/3 market share, the market leader, and you would want to defend your turf, if not anything else, expand upon that lead as well. Tell us a bit about how is that shaping up by virtue of either capacity utilization constraints or manpower availability constraints or what have you. How is the cookie crumbling?
Well, on the market side, if you look at it, with what is happening is that we are seeing a shift in the feedstock. Okay, it's no longer only sugary based streams that are going around. We are now also adding very significantly to that in terms of the starchy feedstock. So, and if you look at my inquiry base right now, it's much more weighed in favor of starchy feedstock compared to sugary feedstock. Of course, the last quarter booking was still not reflective of that. It is starch is still doing because starting from a low base is picking up. So that's one clear shift that we see. That even on the sugary feedstock side, we are seeing customers now moving around with what I would call as moving ahead with syrup as a preferred feed. Syrup and molasses. Nobody's talking molasses C, which used to be just not too long ago that we used to talk about molasses C as the feedstock. So there are feedstock related changes that are happening in the product and the inquiry mix. The size is changing very quickly. We will see as we progress through the year. We expect that the size of the plant will keep going up. Okay, so that's positive for us, because eventually whether I design a 200 KLPD plant or a 500 KLPD plant, for me the effort is same. But obviously on the revenue side, etc. So I think it's a positive accrual for us as well. As we move through the year, we will see this bigger capacity plants play out, especially on the grain side of the equation. So that is something that we will see coming into play. The third thing that we will see is, as I was mentioning, that as hopefully, as the international travel restrictions start to be lifted and we are able to be more mobile with our customers who are outside India's geographical limits. We do have some representation in some markets, but not in all the markets. So there is a lot of restrictions right now. So I think that will ease up, and that should also start to, because that will also be a sign of the fact that those economies are also opening up. So that will happen. Positive concept. I don't know whether you noticed, but on the 10th, the Honorable Chief Minister of UP actually dedicated the first CBG plant to the nation that is built by us at Indian Potash Limited. This is the first 200 TPD investment-based CBG plant. So today, if anybody is driving, or any of your listeners are driving from Delhi to Dehradun or Haridwar and onwards to north, on the highway there is a CBG petrol pump near Muzaffarnagar, where you can CBG gas pump. Where you can actually go and fill CBG into your car. It's become a big hit from the people who are using. I've actually been there personally. I've talked to people who are filling, the locals especially. They're very happy because they're getting high mileage. And that's a very big criteria in India to buy a vehicle or run a vehicle. So I think, of course, the plant will get scaled up now. So it's a good omen for us. And I think as we move through the year, we'll also see some build-up start to happen in CBG. Of course, the full-blown CBG opportunity, 5,000 plant, 1,75,000 crore, that kind of stuff, that is still maybe 18, 24 months away. But we will definitely see a positive construct happening on the CBG side as well. The CPS plant of ours that we've been talking to, our F15 strategy, very focused on international customers, high value add. That's also where we are seeing, we are just building a sustainable aviation fuel. That is for the aviation fuel, a plant from IBA to aviation fuel for our collaborator GEO. It's a demonstration plant that we're building in India, but will be established in the United States. But they have also publicly announced a very large project which is currently under construction, which has gone to the engineering phase right now, where we will be partnering with them to build the commercial scale plant as well. So not only the demonstration scale plant, but even that. So I think very positive construct on that side. We are talking to another customer for the movement that is happening on a clean tech, green tech side. So the big movement on the hydrogen. So we're also going to build some parts of the hydrogen plant on the green hydrogens as well for them. So I'm very happy with the quality of the construct of our order book and efforts and the inquiry book that we have.
Okay, and if I'm not wrong, just one quick follow-up for the CBG thing. This plant that has been inaugurated serves as a demonstration capability for you to get in more clients. I presume you're also doing something with the company that Leafinity in Karnataka, which is also CBG related, right?
Absolutely. So this is based in north of India, and this is a commercial demonstration. So this is not a demonstration. This is a commercial plant. Of course. Commercial plant. Leafinity plant will also be a commercial plant in south of India, and that will get commissioned somewhere in October, November. That's the project schedule now. And we'll be commissioning a rice straw based plant in the fourth quarter of the year. We'll also be commissioning one plant based on spent wash. So spent wash, rice straw, press mud, 3 basic feedstocks. 90% of the potential is going to be covered by these 3 feedstocks. We will have a commercial scale plant working before end of the year on each and every one.
Awesome. So how do you think the year shapes up? You had a fabulous, very good quarter 4. You built upon that in quarter 1 on the order book front. I'm talking about with the highest ever order book, I presume, even though it's just a few crores more than quarter 4, but still, since quarter 4 was such a record quarter for you. How does the year shape up? Do you reckon this run rate can be maintained or expanded? Because the street expects that you could do an order inflow, pure net order inflow of close to about 2,400, 2,500 crores. You've kind of done the 1 quarter of 600 crores. You think this can be maintained or improved upon?
Yeah, so I think we believe that if you look at our current inquiry banks, and assuming that there are no major external disturbances in the environment, I think we are on a path to be on that track. We are expecting, as mentioning, today we are starting the second quarter at around 2,000 plus crore order book on hand to execute. And our plan is that as we move through the year, we'll keep building on this number every quarter.
Got it. And that's by virtue of the execution staying robust, but the inflow being better than the execution.
Yes, execution will stay robust. I've said traditionally first quarter is our lowest quarter, and I don't see that changing, at least not in this year.
No, but the first quarter was actually much better than what people expected. I think most of the notes are talking about how you actually stepped up the execution in quarter one, so to say. So that's interesting. Mr. Joshipura, a question on the operational front, and what was probably a bit disappointing, even though you had mentioned this in all of the previous interactions with me and elsewhere, that because there is no pass-through, there could be an impact on margins.
Yes.
Now, is this purely because of the raw material hikes? Because I was doing some math, and the employee cost as a percentage of sales also seems to have inched up in quarter one compared to quarter four. So what's led to this margin downtick, and what is some color on how things could shape up?
So, Neeraj, great question. So there is a material cost for our job, right? But there's also, because we're a projects company, there's also a lot of site-related costs that walk into construction of the project. So there are two costs that we need to look at. And so, while on the one hand, the material cost number has gone up. On the other hand, if you go through our numbers, you'll find that site expenses have actually gone down by 10%. So if you look at the total sum, and that depends on the scope of work, etc. So if you look at the total sum, we still have about 2 percentage point hit on our margin, no question about it. And that is very clearly reflective of this stupendous and a continuous price hike. I think that's the key issue. Let us say, for example, the price would have changed in 1 point. Then at least from there onwards, I know what to do. This is the case in the whole quarter, and I'll just use some numbers. If we just track back to 9 months from today, just track back 9 months. First 6 months, 30% change in stainless steel price. Next 3 months, another 30% change in steel price. Now that 30% was not a 1 point change. It continuously changed every day without exception. I mean, I was joking with my purchase team. I said, guys, I don't want to see your email every day in the morning, because I know that you will say we have price up by 2 rupees a kilo, 4 rupees a kilo. But that's what it's, this continuous creeping increase is what is something that no contract can manage for us, right? Because there are no continuous equations that are built into our contract. That's not the way and the nature of our industry is. So essentially, 2 percentage point loss. We are at a heavy order book that we are carrying forward from quote unquote legacy costs, and now we have to encounter the new cost. So metal cost has impacted it by 2 percentage point. I'm not taking that away, but that's the impact. Whatever levers we have deployed several levers to see how we can negate that increase in the cost. But fundamentally, the material that we use in our plants is steel, mild steel, stainless steel, cast steel, which are form of steel, but it is fundamentally steel.
No, so the question there from Mr. Joshipura is that is this absorbing, or are these numbers reflective of maximum pain if prices stay stable or go down and don't go up from where they are right now?
Yes, at a level, yes. You're absolutely correct. Some bit of up and down. I mean, depending on the product, may our domestic, our international, what business unit, etc. But per se, yes, what you're saying is correct.
But difficult to go back to quarter four margins.
Well, that would be our attempt eventually. But we have to go through this whole journey, because maybe towards the end of the year we'll reach that stage, assuming that the prices stabilize again.
Yeah, no, I'm only drawing the attention to quarter four because it was just 3 months ago, and you clocked in 13 and a half. So I'm just wondering as to the annual averages could be single digit.
Yeah, there was a special cause in the last fourth quarter, and I think that because the first 6 months of the year were a virtual washed out, right? So there was a lot of accumulated effect also. So we had steel, we had material, but we couldn't convert it. That is not the case now. So now, it's a different speed at which the material is moving now compared to what moved earlier.
No, but my only last question on this is, Mr. Joshipura, the newer conversations, the newer orders that are coming in, they would be coming in with you keeping in mind the higher prices, and therefore, are you bidding for them at double-digit margins, or are you bidding for them at?
Yeah, so we do have a policy now that from the inquiry to the contract with the customer, the time cycles have shrunk, which is one dimension. We're also telling our customers that once we finalize a contract with you, within a very definitive period, and that definitive period is in a couple of weeks and not more than that, we said, if you don't then quote unquote book the order with me in terms of paying the advances and everything, then the price of the new price will apply, because in 15 days the steel price would have changed. So that correction we have brought in, but there is also a legacy order book that I have to execute. There is no choice on that. So we will do that. We are doing several things to see how we can minimize the impact, and I'm sure that we will be able to address some of the problem, if not all of it. But definitely we still have to go through some of this pain as we progress through the year. And to towards the end of the year, we will catch it up.
Okay. So net, this could be the base, so to say, barring some extraordinaries. You hopefully will be at a number which could be higher than what you've done in Q1 on the operational front.
Yes, that's a fair way to put it.
Fair way to look at it. Okay. Last couple of questions, Mr. Joshipura. One is, you already spoke about how the order flow situation for now seems to be robust. Last time you had given us this whole large, bigger picture argument about how much of the plans that we need to set up in order to reach the 1,000 crore target by 23, 25, what have you on the ethanol side. Just trying to understand, if you put all the pieces together, which is the hydrogen piece that you spoke about, CBG plants, and hopefully they pick up in 18, 24 months from now, would it be safe to assume that you anyways on your order inflow are on a path which takes you maybe 25, 30, 35% higher in FY22 and then FY23? And if CBG and all the other things kick in as well, and if alcohol kicks in as well in a big way, breweries, then there could be a bit of a J-curve effect on the order book as well.
Only thing is there are those 3 or 4 ifs in there. So yes.
Sorry?
I said there are 3 or 4 ifs in your question. So yes, if there are 3 or 4 ifs that do sort of crystallize in the right direction, then we are looking at a growing order book, at shifting the orbit for the company, and then that's what our objective is.
Okay. And what's the word of caution aside of the raw material costs rising, which may impact margins? Your tax rates are anyways now discovered at this 26-27%. So all of that is known. What is the unknown risk, Mr. Joshipura?
I think unknowns are in the external environment and not so much in internal environment. In terms of what I would look as what happens to third wave, we don't know. Okay, when do the international borders open up for travel? Yeah, how I hope that the material costs stabilize and they don't keep on this trajectory of growth. So those are the externalities that will have to be managed, and of course we'll have to be on our toes for that. And we are doing all that we can to prepare ourselves for such an eventuality. But at the end of the day, there will be, if such an eventuality does happen, we don't know in what form or in what intensity it will happen. We are doing our best to keep ourselves prepared. At the end of the day, the intensity will decide how well prepared we are or not. That's the way I look at it. Just to share with you one data, I think internally we have 91% of our population covered with vaccination now. All white, blue collar, all put together, casual workers. If you walk into my premise, you have to have vaccination. Okay. So that number is at 91% right now. We're trying to get it closer to 100. So the idea is to take all steps that we can to anticipate a problem and be ready for it. And then, so prepare for the worst and hope for the best.
Well, hopefully the country reaches that number soon as well, Mr. Joshipura. But
yes, I completely wish.
Yeah, but this was lovely talking to you, Mr. Joshipura. Thank you so much for taking the time out and speaking to us at length, and all the best for the quarters ahead.
Thank you, Neeraj. Pleasure as always. Thank you.
The pleasure was ours, really. And viewers, thanks for tuning into this broadcast.
Thank you.